A very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets, if you look at the benchmarks, they are under pressure today. In fact, the Nifty fell below the 200-day moving average after a gap of almost 5 months. Bank Nifty is still far away and is outperforming, but broader markets are relatively softer today. But let's talk about markets and what are the factors which are playing on the mind of the market. Aashish Sommaiyaa, CEO of White Oak AMC, is joining us today. Ashish, good morning. Thank you very much for your time. Ashish, I was just looking at some of the data that whenever, in fact, barring COVID, COVID was a 3 month period. Whenever we
Yeah.
go down below the 200-day moving average, we take say 20 days to a few months, 3 4 months, and spend the time out there. What are the factors in your mind right now which are you know heavy on the mind of the market because of which this underperformance is being witnessed?
So thanks for having me, Ajay. I think, I would broadly put it into three parts. One clearly is, if you really ask me, is for lack of any other word, a waning investor interest, or not waning investor interest, but say a bit of indifference on the part of investors. Because, if you find that for 1.5 year, you are on a treadmill, and more or less the market is going nowhere, then I think people do, some kind of despondency starts to creep in. I think that is one. Second is, if you see suddenly, there were few things which probably one would have imagined that they were behind us, but then you realize that they are not actually behind us, meaning that, the talk of, difficulty in controlling inflation, the talk of, higher for longer, these kind of things are certainly weighing on the minds of markets. In fact, staying with that thought, if you look at it, for instance, the market was kind of getting used to the war, but even the war in Ukraine, it's over a year, it still persists, and intermittently you keep hearing about possible escalations, and sometimes there is a ray of hope that there could be negotiation, but on the other hand, the talk of any form of escalation is definitely disturbing. And the third one clearly is about our own, while valuations have become cheaper compared to where it was 1.5 year back, but the reality is that there is sector rotation, there is inconsistency in performance in certain sectors, and I think so those fundamentals, sustenance or sustainability of fundamentals also causes some kind of doubt in people's minds. So I think these are broadly the three things which is probably resulting in market going nowhere, and that is probably, and you can't see any very many triggers for things to change immediately.
Fair point. Ashish, in fact, it is important to emphasize for our viewers and retail investors that these are exactly the kind of times when, for SIP investor, you can accumulate large, vast amounts of units without, the price going higher. And this is exactly the time where redemption starts happening. So why don't you, this is the age-old kind of challenge you and I both have seen for our viewers and clients of yours for
Yes,
ages. Why don't you repeat that for our viewers' sake? Because right now we are seeing and we are getting a lot of queries on our Twitter handles as well. Is this a time should I
sure.
stop my SIPs and all of that? So why don't you tell
Yeah.
that message once again?
There is somebody, I have the benefit of meeting a lot of people, and somebody quoted me a very interesting analysis that, assuming that people are doing SIPs for, 5 years, 10 years, and this kind of longish period, if you were to be an SIP investor for, say, 10 years, right? Now, let us say in one particular case study, when you commenced your SIP, for the first 3 4 years, let's say market didn't do anything. Let's assume it was something like 2010, 11, 12, 13. Or let's say it is something like 2021, 22. So you started doing your SIP, and first 18 months, 36 months, let us say, nothing happened in the market. You kept on investing and you felt that I am not being rewarded, but say thankfully you persisted. And then there is another case where there is immediate gratification. You start your SIP and you are seeing it, you're hitting the ball out of the park. As soon as your SIP commences, it starts showing you traction in the returns, and you feel enthused and motivated about your investment. But when it comes to end of 10 years, the sad reality is that if you look at it end of 10 years, then the SIP which was very demotivating and went nowhere in the first 3 4 years, it ends up making more return than the second case study where you had immediate gratification and you thought that you had started very, very well. In reality, for SIPs, to give you very good return, you should not be having a good start. You should have a start where the market goes nowhere and allows you to keep putting money at a lower and lower level, and then on a back-ended basis, if the market were to rise, you would do very, very well. Actually, that is one thing. The second thing what I've noticed is that when it comes to individual investors, retail investors, the mutual fund guys that we really deal with, what I've seen is that if you tell someone that the market has corrected by say 25%, and so they would imagine, oh, is it that Nifty has gone from 18,000 to 14,000? What 25% are you talking about? The reality is that today's 18,000 is 20-25% cheaper than 18,000 of 1.5 year back. Because if you look at Nifty EPS, I think from below 700, we are now talking more like 830, 840. And if you take, for example, people like us, we don't look at PE multiples and EPS. We look at, we have an OPCO FinCo framework. So, we look at price divided by free cash flow, and free cash flow is also excess free cash flow after paying for cost of capital. So forget PE multiples. If I take our portfolio, which is to price to asset like free cash flow, what we call, it's corrected by about 30% in the last 18 months. So our portfolio is 30% cheaper than what it was. Yes, you can always contest, which means that in 2021 you were probably above average or you were looking expensive. In hindsight, yes. But today, market has gone nowhere. NAVs have gone nowhere. Standing where we are, the portfolio is 30% cheaper than what it was 18 months back. So I think people react to price corrections, but people don't realize value corrections when they play.
Very valid point. The second part was a very valuable input. Ashish, also, this entire 830, 840 rupees a share EPS for indicative and simplicity terms itself is coming under question. Even if it remains flat for the next 1 year, where do you see margin, where do you see valuation cushion coming in, given the way how historically what range we have traded in, just for understanding purposes, we'll talk about Nifty.
See, when you talk about 830, 840, that obviously is March 2023. Now, and that's say a month away. Maybe there is 2, 3%, 5% here and there on that number. I don't think that will change the fortunes of the market too much, but definitely what can change fortunes for the market is that where will it be next year? And there are a lot of people, if you take street estimates, they are like, 950, 940, basically anywhere ranging from 10 to 15%, you will get different types of estimates. Now, obviously, two ways to look at it. One is that probably that's the concern, which is why we are in this phase where we are going nowhere. So I would say that a lot of those negatives, it's always difficult to say this, these might be famous last words, but I think that a lot of that is already in the price, and that is the reason why we are going nowhere. All these concerns about possibility of war escalating, all these concerns about inflation persisting, and, more onslaught of the central bankers. I think these are precisely the things which is causing market to go nowhere. And yes, you are right that if you are at 830, 840 right now, next year will you be well over 900 or not? I think that is the question. But I feel that, like you said, where are the pockets of value? My sense is currently, anybody and the industry data. You take retail volumes, you take mutual fund volumes. Currently, there is a sense that people are on the sidelines. There are a lot of fence sitters. If you ask me where are the pockets of value, I think there is value in the market because the market seems to be thinking that a lot of the next 1 year is under a cloud. Also, there is a big political event 1 year down the line. So my sense is that these are the things which are weighing down, and exactly these are the times when market ends up leaving value for you because the market seems to be forecasting all the negatives, but doesn't seem to be thinking that eventually these negatives will pass. And just let's not forget, just 1 year back, we were talking about great potential for India. I don't think any of that gets derailed just because market goes nowhere for a year or may not go anywhere for the next 3 to 6 months, for instance.
Right. All right, Ashish, we'll let you go on that one. Thanks very much for stopping by today on the show.
Thank you.
That was Aashish Sommaiyaa of WhiteOak Asset Management. Let's take a short break. More news and updates and big voices